Let's take a look at a question of a bond issued at par and at a discount. Christmas Trees Limited issued $300,000 of 10% bonds on January 1st, 2020. The bonds are due on January 1st, 2025, with interest payable each July 1st and January 1st. The bonds are issued at face value. Christmas Trees Limited uses the effective interest method. Prepare the company's journal entries for A, the January issuance, B, the July 1st, 2020 interest payment, and C, the December 31st adjusting entry. Okay, so on issuance of these bonds, we're told that they're issued at face value. So that means there's not going to be a premium or a discount that we're going to need to amortize over the term of the bonds. We're simply going to record the entry for the proceeds, which are going to be the exact face value. And then we're going to record the interest payments, which is simply the face value times the stated rate. We need to remember to adjust that for the semi-annual nature of the payments. So even though we're told that they use the effective interest method, which normally we would set up an amortization table to make sure we have the proper amounts, we don't need to do that in this case because the bonds are issued at face value. So let's record our journal entry at issuance, which is going to be January 1st, 2020. So we're simply going to have debit cash. The company is going to receive cash from issuing the bond, and credit bond payable. And this is going to be a long-term liability on our statement of financial position. It's long-term because these bonds are not due till January 1st, 2025. So 5 years. They're not going to be payable within the next year or operating cycle of the business. So we know that that's going to be a long-term liability. And this is simply going to be the face value of the bonds. So that's what we're going to receive on issuance. Now, the next thing we're asked to do is have the July 1st, 2020 interest payment. And this is going to be the face value of the bond, so 300,000 times the rate that they pay, which here it says 10%. And we need to remember that 10% is an annual interest rate and says that the interest is payable semi-annually each July 1st and January 1st. So we're going to multiply that by 6/12 because it's payable every 6 months. So we're adjusting the annual rate, the annual nature of the 10% rate. So this is going to give us $15,000. So these bonds are annually going to pay out $30,000, but they're going to make it in 2 payments of $15,000. So our entry for the first payment is going to be debit interest expense. So this is going to go through our income statement as an expense for the company. And credit cash. They're actually going to need to pay out cash to the bondholders, $15,000. We're lastly asked to do the December 31st adjusting entry. Now, why is this an adjusting entry? It's because we know we have a bond payment coming up on July 1st. So we need to make sure we've accrued the portion of that payment that's been earned or by the bondholders in 2020. And it just so happens that they've earned the whole payment. The cash is just going to get remitted the following day, January 1st. So the entry is going to be debit interest expense. And this would be, even if it was, say, 3 of 6 months, you'd prorate this. We don't need to prorate it because they've earned the entire payment. It's actually going to be paid the very next day, January 1st. So the difference here is that rather than crediting cash, as we do in the July payment, we're going to credit interest payable because the cash is actually going to flow out the very next day. And even if it was a few months later, we'd still need to accrue the portion of the payment that was earned in that year, and it would go to an interest payable account, which then, of course, we would need to clear out when we make the payment on July 1st. If we were required to do the July 1st, 2021 entry, then we would have credit cash, debit interest payable to clear out that amount because we accrued the entire amount. You may have a piece of it that would go to interest expense as well, depending on what portion of the period you had accrued. Here again, we're accruing the entire payment because it's going to be paid on January 1st, 2020. So if we go back up, that takes us through part 1. So we've done the January issuance, we've done the July payment, and we've done the December 31st adjusting entry. Let's look at part 2. It says, assume the bonds were issued at 98. Record the journal entries for the January issuance, the interest payment, and the December 31st, 2020 adjusting entry using the straight line method. Okay, so we know that the straight line method is permitted under ASPE. It's not permitted under IFRS. Companies that report under ASPE can elect to use the effective interest method, but they are permitted to use the straight line method. So here we're told the bonds were issued at 98. So the bonds are no longer issued at par. So what does it mean that they're issued at 98? So bond issued at 98, it's going to be 300,000 times 98%, which is going to give us $294,000. So this means that these bonds were issued at a discount. The company issued $300,000 bonds, and they issued them for only $294,000. So they got less than the face value of the bonds. So we know that there's a discount. So the discount is equals $6,000, which is the difference between $294,000 and the face value of $300,000. And we're going to amortize that over the term of the bond. So it's 5 years. It's basically divided by 10 because it's 5 years. 5 years times 2 payments a year per year, which is going to give us the 10. So divide that by 10 and we're going to get $600 per semi-annual period of amortization. Okay, so that's our straight line amortization of the discount. We know that the interest payment on the bonds is still the same. It's the 300,000 times the 10%. That's the stated rate of the bond. That hasn't changed in part 2. So let's do the journal entry at issuance. So now we're going to have the same debits and credits. We're going to have debit cash, and credit bond payable, just like we did in part 1. But the difference is previously we had these bonds issued at face value. So we had 300,000 here. Now we know that they were issued at 98. So there's going to be $294,000 here coming in. Next we've got the July 1st interest payment. And now our interest payments are not only going to be remitting the cash, they're also going to be amortizing the discount on that bond. So this entry is going to be debit interest expense, just like we had before. And it's going to be credit bonds payable, because we need to increase the value of the liability. So we know we need to be crediting it each period, increase that value because we need the $294,000. We need this at $300,000 when the bonds mature in 5 years, and credit cash. So we know that the cash that needs to go out is $15,000. That hasn't changed because our bondholders need to be paid $15,000. We know that we just calculated up here that we're going to amortize $600 per period for the bond discount amortization. So we know we've got $600 there. And the interest expense is simply going to be the sum of those two things. So it's going to be $15,600. And so you can see that when we have a discount, our interest expense is actually higher than the coupon payment on those bonds because we only received $294,000, and we need those bonds on our statement of financial position at $300,000. So we basically lost some money there. So we're going to be recording that through our interest expense. And then our December 31st adjusting entry. And this is going to be debit interest expense. Credit bond payable, because we know every period we're going to need to be amortizing that discount to get that bond closer to the face value. And then credit, and again, the difference in this adjusting entry is that rather than a credit to cash, this is going to be a credit to interest payable, because we don't actually have to pay the bondholders their payment at December 31st. We're simply accruing the portion of it that they've earned in 2020, which happens to be the entire amount, because it's going to be paid the very next day. So this is going to be 15,000. Okay, the bond payable we know is going to be 600. And the interest expense is going to be 15,600. An interesting point, sorry, that's 2 zeros. An interesting point about the straight line method is that each entry is actually the same. So the entries don't fluctuate as they do with the effective interest method. So you can see that our two entries for July 1st and December 31st are the same. The only difference, notable difference in the December 31st entry is that we're crediting the bond, we're crediting the interest payable instead of the cash line. All right, well, that takes us through the conclusion of part 2.